Dhiraj Agarwal joins us. Let's understand his view from the market, where is margin of safety, and what exactly is he communicating to his clients. Dhiraj, good morning. Thank you for joining us. After the recent run-up and looking at the macros we are staring at, what is your house advice? What are you indicating to your clients?
So at this point of time, what we are looking at is markets are in a zone where one needs to be very, very selective and very, very quality focused. I don't think it's a bubble yet. There is more headroom for the market to go up, but it will not perhaps be as smooth and as easy as what we have seen in the last 4 or 5 months, where almost anything and everything was flying. It's time to be a bit more selective because the valuations are. I mean, it's high, but it's not ridiculously high. Uh, and hence, caution is warranted at this point. Being selective is, I think, a good idea.
Uh, why is there such a marked difference in what's happening in the small cap space versus what's happening in the large cap space? The reason why you call them large cap is because they are better managed companies, better return ratios, and they have better moat around their business. They should come under premium. Right now, if you look at mid cap, they are at a premium to large cap. If you look at small cap, they are at a premium to mid cap. And if you look at SMEs, I'm not even getting there.
Yeah. Yeah, that's true actually. And the feature of the market in the last one actually started 2 years ago, but it's been very, very pronounced in the last 1 year. This is what I call the growth chase. And we have seen this happen a number of times in the past, especially when the retail participation in the market is very, very high. So anything which has a higher growth rate simply is getting demanded and bid up at a higher price and at a higher valuation. I mean, take the example of IT sector, for example. On a TTM basis, Persistent is now trading at a premium to TCS. Persistent growth rates are higher than TCS, and that's the growth premium the market is willing to give. Remember, in the last 2 years, the market has become very retail oriented. This reminds me a little bit of the 90s phenomena. As per my estimation, approximate direct inflow into equities, this is outside of the inflows into the mutual funds by retail investors, is to the tune of $20 billion a year. This is a large number because when FIs pump in 20 to $30 billion in a year, we consider that as an outstanding number. So retail is putting in $20 billion direct. Retail is looking for only one metric, which is growth, and growth is being bid up. So across sectors, you will find that irrespective of market cap bracket that stocks or the companies fall in, if a company is delivering higher growth rates than the industry average, it's trading at a premium.
Dhiraj, so just understanding, I mean, where is it that you actually find value on the table right now in the market? And, given that pretty much everything is looking frothy and discovered.
There is no deep value. I mean, there might be some places in the market. So there is no longer deep value at this point of time. There is value only relative to the current outlook or current growth, right? So which is the phase we are in, and which is why one needs to be very, very selective. Mind you, the growth pricing or the price earnings multiple going high because of high growth rate is a double-edged sword. When the growth rates are high, the P's expand, and hence the stock price actually compounds at double the speed as the earnings growth rate. But it works on the reverse as well. If the growth rate slows down, the P contracts. So, which is what I started today's commentary with, that we need to be very, very careful and selective and focus more on quality.
The data coming from US Fed is clear that US economy will expand. They have changed their guidance from moderate to solid. What does that mean for IT? I mean, if US does well, banks will do banks will do well, IT will do well.
So US economy is actually surprising most of the soothsayers or naysayers with its strength, right? So we started the year with a very clear outlook that US will slip into recession by the middle of this year. By end of 23, there'll be rate cuts. That narrative has gone into one of that of soft landing and possibly some rate cuts by end of 2024, and maybe one or two rate hikes prior to that. So US economy is very resilient and strong. But at the same time, one needs to take into cognizance where the US economy's strength is coming from. So there's a little bit of intersector shift. So the current strength is coming in from a huge amount of investments going in post the IRA Act. So either in EVs or semiconductors and manufacturing areas. So there is a little bit of shift from, let's say, tech or consumer strength back into manufacturing. So that changes the composition of the economy slightly. Um, so I'm not too sure if just reading the headline number at GDP means that the IT earnings numbers is going to get revised up very soon. But I think the worst for IT is behind. I mean, I don't expect any more earnings cuts. I don't expect any more cuts coming in because US economy can slip into recession. That fear is off the table.
Dhiraj, morning. Also wanted to understand what the outlook is when it comes to IT, because while rather pharma, because while the stance continues to remain positive, just wanted to know exactly what kind of companies within this space are looking attractive, and are you at all not worried about the expensive valuations that they command?
Pharma valuations, I don't think have become ridiculously expensive yet, despite a strong outperformance in the last few months. Remember, I mean, my view is that the US generics is bottoming out after almost 6 to 7 years of high teens price erosion. It's now settling down to mid single digits kind of a price erosion annually, which is excellent for Indian pharma companies because that's the kind of price erosion Indian pharma companies are prepared for, can absorb and grow. Most of the Indian US generic facing companies have excellent pipelines. And the big pain in the last 6 or 7 years was very steep price erosion. Once that settles down, we can see secular 4 to 5 years, maybe more steady earnings growth coming in the pharma space. So if I connect it back to what I said just a few minutes ago, that markets at this point of time are looking for sectors or companies which can grow faster than the market, which can grow better than the industry average. And that's the space that's being chased because growth is now becoming a little bit scarce again. And given that context, once the conviction sinks in that the pharma revival or the pharma earnings revival, not the stock price, the pharma earnings revival is more sustainable and more like 4, 5, 6 year kind of a phenomenon, I think the valuations will sustain.
Why are private banks underperforming, Dhiraj? I mean, that is the safest, the best, and the easiest trade. Yet it is turning out to be the worst trade for this year.
Yes, it's markets have become a little rotational in nature. And the other thing, and this is again looping back to what I said, that the markets are very, very retail heavy. So retail has actually become price setters, and institutions have become price takers in this market. And it's back to those 90s style of investing where people looked at relative valuations, relative ROAs, and relative growth, and then just chase the ones which are cheaper. So for a long time, we had stopped talking about this, right? That I mean, you took the example of banking, so let's stick with banking. That the best player in the sector is, let's say, 2.5 times price to book. Then something else which is delivering similarly good numbers is at 1.5. So you buy the one which is at 1.5. So which is actually benefiting the PSU banks. Even within PSU banks, mind you, last 9, 10 months, SBI is actually flat, and the bulk of the action in PSU bank has moved to relatively cheaper names within the sector. So PNB is up what, 40% YTD. Bank of Baroda is up 16, 17% YTD. SBI is flat. Kotak and HDFC Bank are negative. So that whole relative valuation with respect to growth is the play in the market right now, which often happens when retail money actually becomes a dominant force.
Sure. So, Dheeraj, as a portfolio strategy, what is it that you would recommend, viewers watching this interview do? Book your profits, at least when it comes to the frothy small and mid caps. Keep the powder dry. At some point, there will be value and you can buy more of the same.
I don't see a deep correction in the market. And the reason for a deep correction not coming in, there could be shallow pullbacks, yes, of course. The reason for perhaps a deep correction not coming in is that the large cap valuations are not frothy at all. So my recommendation at this point would be to book profits in small cap or mid cap names where clearly the investors have become lucky, where the earnings are not really supporting the current valuation. So one should take a look back at earnings and valuations and say, well, this one ran up without any too much of earnings bump up, but only on hope and narrative, and incrementally start moving a little bit of money towards large caps because another interesting metric I saw recently was that FII overweight position in India in the EM funds is only 100 basis points right now. At peak, which is about 2016-17, it was 500 basis points. So if that positioning changes over the next year or two, bulk of the money will once again come into the large cap names. So relatively speaking, I think some amount of gradual shift out of mids into large, especially the mids which are looking frothy, is I think what one should do.
All right, Dhiraj, really appreciate your time. Let's look at those small PSU banks. They've come back. Markets can remain extended for an extended period of time. All I'm saying is that when hope and narrative it takes over, then risk